So, as a continuation to yesterday's video, I'd like to mention two other types of trades that I think are very good during market crashes, actually. So, the first one is the same as yesterday, which is selling an out of the money put for earnings. But I'm going to explain why I think it's even better around during a market crash. And the other one is selling a zero DTE trade. So either selling a naked put or a put spread on an underlying that expires the same day. So the advantage of selling an out of the money naked put or put spread around earnings during a market crash is when the market is crashing, VIX is higher. So the volatility is higher. So expected move is higher. So premiums are higher. Plus, the way you enter an earnings trade is that, like I showed you yesterday, you enter it right before the close and then you close it the next day. So if you enter a trade right before the close, you don't worry about what happens the rest of the day or during market hours when the market is open, and you're only affected by earnings reaction. You're not necessarily affected by general market movement. The market might be crashing, but you're in the trade for a few minutes before the close and then a few minutes at the open the next day. You're only really affected by earnings reaction, even during a market crash. The advantage of the environment of a market crash is that expected move is going to be high, so your strike is going to be further, making it safer. Now let's look at a few examples. So Nike, we looked at Nike yesterday, so let's look at the last crash, March 2020 crash. So if we look at the chart over here, if we find 2020 and we look for March for Nike, I'm just trying to find it here. So there you go, you see March 20, if I hover over it, I could see the details, I think. So yeah, there you go, March 24th, 2020. So that's in the heart of the crash. Expected move was 8.1%. And as you can see, the stock ended up moving 10% to the upside. So in this example, an out of the money naked put would have won easily. I'd expected move on top of that. Premiums would have been higher as well. And while the market is crashing, you don't even have to worry about all that. You're in a trade for less than 10 minutes and you make some good profit. Now the risk, of course, is the stock could have bad earnings and the reaction is very bad and the stock drops outside of expected move. So you need to make sure that you can afford rolling the put in case it gets breached. You need to make sure you're comfortable rolling at that particular strike. If you're not, then don't play that stock, play a different stock. And even if you play it as a put spread, at expected move, you'll collect $1 at expected move, risking $4. Let's say you don't want to try and save the trade, then you'll just take the $4 loss. But if you see it not just as one trade, but a combination of trades, and if you play a whole earnings season with out of the money put credit spread at expected move, you'll probably win more times than you will lose the $4. So now let's look at Apple. I just changed it to Apple over here. Now let's look at March 2020 as well. So this is July, we want March. So this is April. So it looks like Apple didn't have earnings in March, but it had earnings in April, which is right after the crash or during the crash. Volatility was still high, VIX was still high. And we could see that, what was the expected move? So the expected move was 4%. So the expected move was 4%. The stock ended up dropping 2.6%. So it did drop, but it did not drop past the expected move. So an out of the money put would have still won in this case, as long as it didn't drop even more after the market opened. So there's a risk that this is actually showing what the actual movement was at the open. After the open, the stock might have dropped even more, might have gone back up, who knows. We could probably check April 30th, 2020. So let me go to Yahoo Finance. All right, so April 30th, 2020. Let me just make sure it's April 30th. Yeah, April 30th. All right. So April 30th, 2020, stock closed at 73.45 and it opened the next day at 71.56. It had a low of 71.46. It had a high of 74.75 and it closed at 72.27. So looks like an out of the money put would have been an easy winner. Let's look at Facebook during the crash here. So there was nothing in March, but there was April 29th. Expected move was 6.2%. The stock ended up moving above expected move, but to the upside. So it moved 6.6%. So once again, an out of the money put would have been a winner. So during the market crash, when volatility is high, if you had played earnings on Facebook in the trade for one day, less than a few minutes, you would have made money with that. Let's try Amazon now. Probably not a naked put. Not everyone could do a naked put on Amazon, but let's do a put spread at expected move. So 2020 doesn't look too good with Amazon. So April 30th, expected move was 5.2. It actually dropped 5.5%. So in the case of Amazon, if you had done a put spread, it probably would have been a loser, but we don't know how big of a loser. Maybe it would have been maybe a $1 loss. Max loss would have been $4. Maybe Amazon came back up afterwards as well and closed at expiry above your short strike. Who knows? If you tried to roll it, you would have been able to save it for sure. But if your plan is not to roll it and just close the trade, take whatever you get. Let's go see in the chart what happened to Amazon April 30th. All right, so it's probably this one here. So April 30th, Amazon closed at 24.74. The next day it opened at 23.36. It had a low of 22.58. So it definitely went past the long strike of the put spread. So it would have been a max loser. And then it closed at 22.86, so definitely a max loser still. But the expiry was May 1st. Yeah, it would have been a May 1st expiry. So in the case of Amazon, it would have been a max loser of $4 if you didn't try to save it, if you just took the loss. Let's look at American Express. So 2020, we've got April 24th as well. Expected move was 5%. The stock ended up going up 2%. So an out of the money put would have been a winner. Let's look at CMG, Chipotle. This one would have been a put spread. Now let's look at around earnings there. April 21st, the expected move was 9.5%. Actual move was 7.9% to the upside. So we would have had another winner as a put spread around a market crash. Let's look at Disney. It was affected by the market crash, by COVID. Let's see what would have happened around earnings. So in 2020, we've got the closest thing we've got February 4th. I think that was before the crash. During the crash, the closest thing we have is May 5th. Expected move was 5.7%. The stock ended up barely moving. So once again, an out of the money put would have been a winner in this case. Let's look at FedEx. You can see that FedEx closest earnings was March 17. So this was during the crash. Expected move was 12.4%. It ended up dropping 4.8%. So it dropped after earnings, but it did not drop more than expected move. So an out of the money put spread would have been a winner in this case as well. Let's look at Google. I think Google would have been bad actually. March 20th. Actually, April 28th, the stock went up. So expected move was 4.9%. Stock went up 9%. So an out of the money put spread would have been a winner on Google as well. Let's look at Microsoft and Netflix. So Microsoft first. So during the crash, April 29th is the closest earnings during March 2020 crash. Expected move was 4.2%. Stock actually went up 1%. So put spread or naked put at expected move would have been a winner as well on Microsoft. Let's look at Netflix. Netflix, actually see expected move was 10%. The stock dropped 1%. So another example where an out of the money put around earnings would have been great during a crash environment. And finally, let's look at Nvidia. Nvidia, we've got a lot of earnings here. Okay. So March, the closest thing to March here is May 21st. Okay. So expected move was 5.7%. Stock went up a little bit less than 1%. So another example where an out of the money put around earnings during a crash season, crash environment would have been a winner. And finally, I guess we could do Tesla. How can we not do Tesla? So Tesla March, April 29th as well. Expected move was 9.7%. Stock went up 6.8%. I just want to find more earnings during March, not necessarily in April, because April is when things started to go back up again. Let's look at maybe the banks or JPM. Let's see JPM. So JPM during it was also April 14. Stock went up after earnings. Let's do Shopify. Last one here. March. So we've got May 6th. Expected move was 8%. Stock dropped 2%. So it would have been a winner as well, with an out of the money put credit spread at expected move. Now the other trade that would be great during a market crash is zero DTE. Now I do have a video where I talk about a zero DTE trade on the triple Qs, but SPY and triple Qs, they have 3 days a week expiry: Monday, Wednesday, Friday. So a trade that you can make during a market crash when VIX is super high and you want to avoid market exposure, you don't want to be in the market too long because of the market crash, is a same day expiry trade. So you make your trade at the open, expiring same day, and if it's a put, you just hope that the stock doesn't drop even more, because during a market crash, the movement usually happens after hours. The market opens already making a big downward movement after hours. So usually there's less movement during the market hours. So hopefully you're out of the money, because VIX is high. Your strike, if you sell a put, an out of the money put, your strike will be further because VIX is higher, making your short strike safer, and you have a better chance of winning. So let's look at an example in March 2020 on the SPY. Now, of course, I don't know what the expected move was, but let's just look at the movement of SPY. So let's go back to March 2020. So I think the worst day, well, we could see it right here. It wasn't March 4th though, was it? Am I still in, yeah, I'm still in 2021. So I need March 2020. This is June. All right, so this is March 23rd is the worst day. Okay. All right, so let's look at the worst day. So the worst day on the SPY here was March 23rd. You can see that the SPY opened, actually look at the day before. The SPY closed the day before at 228. And then March 23rd, it opened at 228, but it had a low of 218. So it dropped 10 points, but it ended up closing at 222. So it dropped around, the movement that it made was about 6 points. 6 points on 228 is about 2.6%. That's the difference between the market open and the market close for the SPY on the worst day, on the lowest day on the SPY. Now, because the SPY is this low, VIX would have been super high, making your short strike that day probably below 222 for sure. And you would have collected a lot of credit, and it would have been a winner playing a trade during a market crash. You get your money back. You're sitting with cash at the end of the day. You're not holding in anything into the close, and you would have made a good profit. And now March 23rd, was it an expiry? Was it March 24th, 25th? So March 20th was a Friday. 23rd is a Monday, so that was an expiry. 24th is a Tuesday. 25th would have been another expiry. So let's look at the 25th. SPY opened at 244. It had a high of 256. So you could have actually closed the trade in a few hours, because if you had opened the trade at the open, you would have been able to close it in a few hours. And then it had a low of the day of 239 and it closed at 246. So there's another example where a zero DTE trade on the SPY would have been a winner during a crazy market crash or high volatility environment. March 27th is a Friday, so another expiry on the SPY. It opened at 253. It had a high of 260. It had a low of 251, and it closed at 253. So definitely an out of the money put at expected move would have been a winner as well on that trade. So these are trades that I would definitely do myself during a high volatility environment. The hard part is being prepared for it, because right now I've got a lot of positions open. Will I have enough available buying power to do these trades in case of a market crash? So that's the problem, that's the issue to consider. But if I were all in cash and my plan was only to play earnings and only to play zero DTE, I think it's a viable strategy, especially during high volatility environment. But right now, zero DTE is hard. Same day expiry trades is hard because VIX is low, and if the SPY is at 476, the strike that you'll have to choose is 475, which is not really safe, or it's not comfortable. But when VIX is at 80 and SPY is trading at 230, you could probably take a 215 strike for the same day expiry. But it's obviously scary because during the market crash, we had when the market halted, we had circuit breakers, I think. So that's kind of scary, where the market halts and when it reopens during the day, you don't even know what it's going to open at. So it could open below your strike, and you don't have time to manage the trade. So nothing's easy, but it's just definitely a trade that I would consider during market crashes, especially earnings. Earnings is probably less stressful because you're in it 2 minutes before the close, you wait for the reaction, next day you just close it. It's also kind of fun, it's less stressful. But zero DTE, you're sort of watching the trade during the day while the market is live and is doing crazy things. So it's a little bit more stressful, but earnings is you just set it, watch, enjoy, and then next day close the trade. All right, so I just wanted to share these two trades with you. So if you have any questions, leave in the comment section below. Like always, if you're going to open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. Thanks for watching.